Welcome to Tesla Deep Dives.
The topic today, the Optimus Gen 3 strategy, analyzing the financial reality of Tesla's 1 million robot per year vertical monopoly. Welcome to the deep dive on the most consequential pivot in modern corporate history, Tesla's dramatic shift from an EV company to a physical AI powerhouse, centered on the Optimus Gen 3 robot.
The thesis is clear. Elon Musk is executing a massive vertical monopoly strategy, betting that the ability to mass-produce a $20,000 general-purpose humanoid robot will unlock trillions in economic value. This shift is so fundamental that Tesla announced it will discontinue its flagship Model S and Model X in Q2 2026 to convert the Fremont factory to an Optimus and Cybercab production hub, and a projected selling price in the $20,000 to $30,000 range. This vertical monopoly is built on proprietary hardware and AI. The robot is controlled by a single foundation model architecture neural network, leveraging the same underlying AI system and FSD computer hardware developed for their autonomous vehicles. The company had to vertically integrate custom components, like actuators, due to a non-existent robotics supply chain, a challenge Musk himself acknowledged would make the ramp-up slower and more difficult than previous vehicle launches. The financial reality of the transition is complex and jarring. Tesla's full-year 2025 revenue of $94.8 billion marked its first annual decline, down 3% year-over-year, which would typically crush a stock. Instead, the market reacted favorably to the earnings call announcement, sending the stock up 3% in after-hours trading, confirming that investors are now valuing the company not on current vehicle sales, but on the future promise of AI and robotics. Of its $483 price target to the Optimus project alone, signaling that Wall Street is actively pricing in the robotic future. The core skepticism focuses on technical feasibility and geopolitical risk. Critics on platforms like X and industry forums question the technical leap required for a general-purpose robot capable of tasks like acting as a household assistant and even surgeons, a future Musk has predicted. Furthermore, the mass production cost target of $20,000 is heavily reliant on the supply chain. A Morgan Stanley analysis suggested that excluding crucial Chinese components would see the build cost balloon from an estimated $46,000 to $131,000. Elon Musk has doubled down on the hyperbole case, stating, "I think long-term, Optimus will have a very significant impact on the U.S. GDP, and that the robot business will eventually be more significant than Tesla's vehicle business." This quote perfectly frames the high-risk, high-reward strategy, a move into a market that experts believe could reach $5 trillion by 2050. Our conclusion is that the Optimus Gen 3 strategy is fundamentally good for Tesla's long-term valuation, but presents extreme short-term volatility. The stock's current price-to-earnings ratio of 259x earnings already embeds a massive amount of future success, meaning any delays or performance shortfalls in the Q1 2026 prototype debut will result in significant corrections. The trending prediction is that Tesla will achieve low-volume commercialization by mid-2027, driven by internal factory deployment, but the 1 million unit per year rate is highly unlikely before 2030, given Musk's own warnings about the difficulty of the ramp. The vertical integration gives them the cost advantage, but geopolitical supply chain reliance remains the single biggest operational threat to the monopoly vision. The key proprietary component as the true test of their vertical cost control and the viability of the $20,000 target. Let me know what your thoughts and leave your comments. Thank you for joining us for this deep dive. To ensure you never miss a pivotal analysis, please like the video, subscribe to the Tesla Deep Dives channel, and hit the notification bell. Your engagement fuels our critical research.